All right, let's get into it, Amanda. Okay. So we will start just by discussing it,
Okay.
Amanda. Ne? And I believe that's something
Okay.
that we discuss. It becomes better to understand compared
Yes.
compared to something sometimes that you read. Yeah. All
Ewe.
right. So we are talking about absorption and direct costing method. Okay.
Okay.
That's where we will begin for today. Are you with me?
Yes.
Okay. So now, okay, you must remember that management accounting, right,
Mm.
is for internal reporting. Okay.
Yes.
Right. So this is actually, I want to put you, and it's good enough that you are working there. I
Mm.
want to put you inside the company, my friend. Right.
Okay.
So now we are running most of the time in management accounting is designed from a manufacturing point of view. Ne?
Okay.
But it does not only mean it's applicable to manufacturing companies only. No, it also works for service companies. But majority of the theory, for us to be able to understand it, Amanda, we must we usually come from a manufacturing point of view.
Okay.
I would mean.
Yes, I'm with you.
All right. So now we are in a company, Amanda. Okay,
Mm.
and we want to know, right, that in the current year, are we going to make a profit or not?
Not okay.
Right.
Mm.
So absorption, net direct costing method, right? We use them just to prepare your income statement, when Amanda.
Okay.
Right. So direct method, right? It is also called variable. So it's a direct or variable costing method, my friend. Are you with me?
Okay. Yes, I'm with
Okay.
you.
So now let's talk about the difference. What is the difference, right, between the two methods? Right?
Yes.
The difference between the two methods, Amanda, right? The difference between the two methods is the treatment of fixed. Actually, let me say it's the treatment of fixed
Mm.
manufacturing
Course.
costs. Okay,
Okay.
that is the difference between the two methods. Okay, so the
Okay.
absorption costing method, right? Absorb absorption costing method says the fixed manufacturing overheads, we'll call them like that name, fixed manufacturing cost, fixed manufacturing overheads,
Yes.
right,
Okay.
are part
Mm.
of your product cost. I'm gonna come back to that one name. Whereas,
Okay.
right, whereas the variable costing method says the fixed manufacturing overheads are period costs. Okay. Are you with
Okay.
me?
Yes, I'm with you.
So now, let's then answer this question, right? What
Mm.
is a product cost,
Yeah.
right? What is a
Yes.
product cost? Example will be igwinya mngani wami. Okay?
Okay.
Ne? So when you are looking at
Yes.
igwinya, Amanda, ne?
Mm.
What ingredients go into igwinya? I'm sure it's gonna be flour,
Your
right?
flour, your cooking oil,
It's gonna be water,
your salt.
cooking oil,
Mm.
right? Cooking oil,
Mm.
salt.
Your salt, your
What
sugar,
else?
your yeast, your dry yeast.
Yeah, sugar and yeast, right? Okay,
Yes. Yes.
are we together?
Yes.
Okay, so when you look at those, actually, before we say and yeast, right?
Mm.
Let's say yeast, yeast, right? Labor, ne? Remember, there's someone who's gonna be
Yes.
working there, Amanda,
Yes.
right?
Mm. Yes.
Let's then look at those ingredients, right?
Okay.
Something that is interesting, we can be able to tell how much flour did we use ekwinyeleli one, Amanda. Maybe let's take kwinyeleli one, we use 1 tablespoon.
Mm.
Are you with me?
Okay.
Ne?
Yes.
Right?
Yes.
So, uh, and then you will have stuff like your water. Remember, sometimes when you are pouring water, you wouldn't measure it. You'll just pour with a jug and be like,
Uh,
it looks okay. Ne, Amanda?
yeah, that's enough. Yeah.
But you
Mm.
wouldn't know how many liters did you pour. You
You
judge with
wouldn't
your
know.
eyes.
Mm.
Isn't it so?
Yes.
Are you with me?
Yes.
Ne? And then
Yes.
we can be able to estimate, okay, ukwenza maybe kunyeli one, Amanda, it takes me about 5 to 10 minutes. Are you with me?
Mm.
Are you
Yes.
following, Amanda?
Yes,
Okay.
I'm here. I'm
And
following.
then there will be issue of electricity or your fire, Amanda. Right?
Mm.
Okay.
Yes.
All right. So from these ingredients that we've seen, Amanda, here, ne? Then
Mm.
these ingredients can actually be grouped, right? These
Okay.
ingredients can actually be grouped into what's called a okay. If product cost yako,
Okay.
Amanda, it will include immaterial, of which in this case it will be your flour,
Okay.
right? It
Yes.
will also include um, it will also include it will also include indirect labor. In this case,
Okay.
is the person that is making igwinya. Are you with me?
Mm-hmm. Yes.
Right? It will also include what we call variable manufacturing overheads, right? In this case,
Yes.
as an example, it will be salt, sugar, and cooking oil. Why are
Okay.
we saying these are variable manufacturing overheads? It is because, Amanda, when you are looking at Igwinya, Amanda, you wouldn't know or you wouldn't trace how much salt, sugar, and oil that is included in that Gwinya, Amanda.
Yeah.
Are you with me?
Yes.
Are you following?
Yes, I'm following.
Okay. And then, lastly, Amanda, we will have something also that is called um, we will have something that is called fixed manufacturing overheads.
Okay.
What is it now? Not equals
Mhm.
fixed manufacturing overheads, name.
Mm-mm.
So these fixed manufacturing overheads, they can include something like, e.g., depreciation. Uyayibona ngisho sisebenzisa isitofu or ibhodo, and then depreciation remember from accounting, depreciation will always be 20% for the whole year.
Okay.
Are you with me?
Yes.
Okay. So if product cost, Amanda, it includes only these four items.
Okay.
Name. So it can be whatever product, Amanda. Your product cost, everything that goes into any product will always be classified into four items: material, direct labor, variable manufacturing overhead, fixed manufacturing overheads.
All right. Okay.
Are you with me?
Yes, I'm with you.
For sure, now you are sitting on a desk, right? Okay,
Yes.
you are writing on a desk rather. There.
Mm. Yes.
And then in that desk, there's wood, which will be your material. Ne?
Okay. Yes.
And then there's direct labor, which is your carpenter that made that desk, Amanda.
Mm-hmm.
Right? There will be variable manufacturing overhead. Your variable manufacturing overhead, it will include your screws, your glues, your painting of the
Paint.
desk.
Mm.
You know what I'm
Okay.
saying? Ne?
Yes.
Okay.
Okay.
Then there will be your fixed manufacturing overhead. So this might be the salary of maybe a supervisor. You find that maybe the company is producing chairs, doors, and desks. Ne? The supervisor will be
Mm.
supervising everyone. Are you with me?
Okay.
He
Yes.
does not specifically supervise the people that are making a mat desk, my friend. But that person will pay him the same salary, irrespective of how many people did he supervise, my friend.
Mm. Okay.
Are you following, Ganon?
Yes. I'm
Okay.
following.
All right. So now, another term that we need to explain
Okay. I
before
have
we
I
go.
have a question. I have a
Not a
question.
problem. Please ask.
So if you're saying we fixed manufacturing overheads, umzekelo wenza the salary of a supervisor,
Mm.
um, then what happens with the salary yabantu who are doing the actual product?
Be it easier, direct
Sickness,
labor.
direct labor. Okay.
Mm.
Okay. All right.
Ne?
Okay.
Okay. So let me explain the concept here, overheads.
Okay.
Ne? E
Yes.
overheads, Amanda, it is any cost that cannot be traced directly to a product.
Okay. Okay.
Are you with me? So
Yes, I'm with you.
overhead can either be variable or it can be fixed. Ne? So when we are saying it's variable, something that varies, Amanda, it's something that changes.
Changes. Yeah. Okay.
Ne? Are you a
Yes.
Christian?
Yes, I am.
Okay. I know there's a verse in the Bible whereby I forgot where it is, but I think it's in the New Testament. I'll find it one day, but it says there is no variation. I think it was one of the new of the disciples whereby they were saying there is no variation in Christ, meaning Christ does not change, my friend. You know
Yeah.
what I'm saying? You know,
Doesn't.
so something that varies, Amanda, is something that changes. It is subjected to something.
Mm.
Yeah, so
Yes.
it
Okay.
does not change on its own, but there is something that influences it to change.
Okay.
Are you with me?
Yes, I'm with you.
So just like your salt, your sugar, and your cooking oil, they will change because of the number of magwinyas that we've made, Amanda.
Mm.
Are you with me?
Yes.
Right? However, there will be some overheads, Amanda, that will remain constant irrespective of how many magwinyas you've done.
Oh, okay. Okay.
Are you with me?
Those are fixed in manufacturing overheads.
Those are fixed manufacturing overheads.
Oh, okay. Okay.
Ne?
Yes.
All right. Let's go back to this point that I spoke about here, where we spoke about the difference. Ne?
Yes.
We said the difference, it is on the treatment of fixed manufacturing overheads. Ne?
Okay. Yes.
So, what does it mean? It then means when we are talking about absorption costing method, absorption costing method, it says when you value igunya lakho, Amanda, right?
Mm.
You need to
Yes.
consider all of these four costs, which is your
Okay.
material, your direct labor, variable manufacturing overhead, and your fixed manufacturing overhead.
Okay.
Right?
Yes.
Whereas direct or variable manufacturing, direct or variable costing method, it says no. When it comes to me, I only consider these three as a product cost: material,
Okay.
direct labor, variable manufacturing overhead.
Okay.
Hence hence the formula says variable or direct costing method, because all of these costs, Amanda, they vary depending on the number of products that you have produced,
Mm.
Amanda.
Yes. Okay.
Flour will vary depending on the number of magunyas you've produced. The
Mm.
number of hours that will be worked by the workers will vary depending on the number of magunyas that you have produced. Your salt, your sugar, and cooking oil will vary depending on the number of magunyas that you have produced. Hence the name variable costing method, Amanda.
Mm. Okay.
Are you with me?
Makes sense. Yes, I'm with you.
However, the absorption costing method, it says, nope. If you want to value a product correctly, right, you must
Mm.
include the fixed manufacturing overheads also.
Okay.
Ne?
Okay.
Let me tell you something. This is actually a absorption costing method. Ne? It
Mm.
is an IFRS concept,
Mm.
right?
Okay.
It is
Yes.
an IFRS concept because this is ISA 2,
Okay.
right? This
Yes.
is ISA 2 when we are talking about inventory. Ne?
Okay. Yes.
So, in other words, it means when we prepare our statements using the absorption costing method, we will be in compliance with IFRS, my friend.
Okay.
Ne?
Okay. Yes.
Right? Because remember, in FAC 3701, Amanda, everything that we do, ne, We must
Yes.
comply with IFRS, mngani wami. Are you with
Okay.
me? Right?
Yes, I'm with
We
you.
don't do anything that we want to that side. You can be disclosing inventory in your financial statements. They must be in compliance with what ISA 2 says. You might be disclosing your property, plant, and equipment in your balance sheet. You must comply with is it ISA 16? Yes, it's ISA 16. Are you with
Okay.
me?
Yes, I'm with you.
Ne? You might be disclosing your investment property. You must comply with ISA 40. Are you with me?
Yes.
My point being, Amanda, ne?
Mm.
When we use absorption costing method in management accounting, right, we will be
Yes.
in compliance, right, with ISA
Yes.
2 of your
Okay.
IFRS. Why? Because IFRS says when you value inventory, you must include these four
Mm.
costs.
Okay. Okay.
Akir,
Yes.
I forgot to ask you, where do you stay?
I'm in Gqeberha, Eastern Cape.
Oh, Lord, so far.
Yes.
I'm in the capital city, I'm in Pretoria.
Oh, okay.
Yes, interesting, eh?
Yeah.
Okay.
Interesting.
That's awesome. Name my friend. All
Okay.
right. So these are the concepts that we must understand, and all of this it's coming from learning unit 1 and learning unit. When it comes to your variable cost, your fixed cost, and stuff like that, ne? All of this is
Mm.
covered in learning unit 1, my friend.
Okay.
Ne? But we'll get there.
Yes.
We'll move nicely.
Okay.
All right. So let me see what else do I want to explain to you here. Oh, okay. Remember, there's this statement also that I mentioned here, um, whereby I said the variable costing method, right, treats a fixed manufacturing overhead as a period cost, right?
Yes.
So now the question is, what is a period cost, right?
Yes. Yes.
A period cost, Amanda, it is a cost, right, that is incurred, right, that is incurred for non-manufacturing purposes,
Mm. Okay.
right? So now, the variable costing method will say, actually, to value your inventory, ne? To value your inventory, you don't need to include fixed manufacturing overheads. Reason being, right? Your fixed manufacturing overheads, they do not change within a
Yes.
relevant range. Let me
Mm.
give you an example. Like now, if you hire an office, right?
Yes.
If you
Yes.
hire an office, your rent wouldn't change for a period of a year.
Yes.
Yeah? So now,
Yebo.
then if variable costing method will say, now if you want to value your services, the cost of your services, you don't have to include rent in the sense that your rent will remain constant for the entire year. Are you with me?
Yes. Yes.
Rather treat rent as your period cost instead of treating your rent as your product cost.
For that cost. Okay.
Are you with me, Amanda?
Yes.
Okay. So let me show you. Just give me a second. I want to grab some water. Just
No
one second.
problem. No problem.
All right. My apologies.
No problem.
Okay. So now what I'm about to show you, ne? I will
Mm.
show you how you will usually prepare these statements. Ne? I'll do the
Okay.
absorption this side,
Okay.
right? Absorption method, and then I will do the variable variable costing method this side. Okay,
Okay.
so we'll usually start with our cells, right? And cells are usually the same, nothing
Yeah.
changes.
Yes.
Ne?
Okay.
After our cells, okay, remember with this side on your absorption costing method, we said we follow in IFRS. So you will be
Mm.
doing your income statement just like how you do it, go accounting, my
One
friend.
thing. Yes. Okay.
Yeah. So here you will
Yes.
have less cost of sales, right?
Yes.
Less cost of sales. However, this side you will have this side you will have less variable manufacturing cost, or you can say variable
Okay.
cost of sales if you want.
Okay. Variable cost.
If you want, or you can say less variable. Uh, yeah, let's say less variable cost of sales. It's fine. Ne?
Okay.
A cost of sales, Yako, what does it include? It will include opening, inventory.
Inventory purchases.
All right. Ne? So
Mm.
this side, since we are manufacturing, we wouldn't have purchases. Angisho. So
Oh.
we will
Okay.
have your manufacturing costs,
Cost. Okay.
ne? Of which
Yes.
manufacturing cost Yako, it will include your material, right?
Okay.
Your direct labor, right? Your variable manufacturing
Overheads
overheads,
and your fixed.
and your fixed
Okay.
manufacturing overheads. Okay?
Mm.
And then this side, you'll have your opening, right? And then you'll have your you'll have your opening and then your manufacturing costs, right? And then your manufacturing cost will include your direct material,
Mm.
direct labor, and your variable manufacturing costs.
Okay.
Okay, can you see the difference?
Yeah.
Okay,
Yeah. There's no fixed on this side.
yes. And then
Okay.
after that, you'll have your closing, right? And then
Okay.
this side, you'll have your closing also. Okay,
Okay.
and then you will have your unadjusted gross profit, right? And then this side, you will have contribution. Okay.
Okay.
And then
Contribution of
here
what?
you will have, yeah,
What is contribution?
contribution is similar to gross profit, but it is not gross profit. But we
Okay.
call it contribution. It's the difference between your sales less variable cost of sales.
Okay. Okay.
All right. Actually, let's do this, ne? Before we put contribution. What we have there, ne?
Mm.
You will have, okay. You'll see when we are doing it practically. But what we need to do here, we'll have to say less variable selling and admin costs. So,
Okay.
okay, you will have your answer here, my friend.
Mm.
You will have your answer, right? And then after that answer, you will say less variable selling and admin costs, right? And then that's when you get your contribution.
Mm-hmm.
It's contribution towards fixed costs, because you can see here on top, we don't have any fixed costs.
Oh, yes.
Ne?
Okay.
And then this side, you will have over or under applied overheads,
Okay.
right?
Yes.
Under wako, always put it in brackets, because that's how we cram it. If it's over, you plus. If it's under, you
Mhm.
minus. Ne? And that's the
Okay.
concept that I'm going to explain after this. Ne?
Okay.
All right. And then after that, you'll have adjusted gross profit. And then you will say less non-manufacturing costs. All right. And then this
Mhm.
side, you'll say less fixed costs. And then your fixed cost this side will include fixed manufacturing overheads, right? As a principle, I want you to master it from here, because your friends do not know them. This will be actual fixed manufacturing overheads. I'll explain the concept just now, ne? And then you'll
Okay.
also less.
Okay. I think
Uh,
I'm confused a little bit. Ne? Didn't we
all
say
right.
with variable costing method, we don't consider a fixed manufacturing overheads?
Good product cost. So
The product
now,
cost. Okay.
yes. So mangabe yayibona
Oh,
njengoba
okay.
isho. This is your product
Yes.
cost. Are you
Okay.
with me? But angisho lana
Okay.
senze income statement.
Okay. Makes sense. I
Ne?
get you now. Yeah.
All right.
Okay.
And then you will less your fixed selling and admin costs. And then you get your net profit.
Okay.
Ne?
Yes.
This side you will have fixed selling and admin. You will have selling and admin, including both fixed and,
And variable.
and variable.
Okay.
And then after that, you get your net profit. And then you're done. So this
Okay.
is learning unit 5, just like that.
Okay.
Mm. That's the difference between your absorption costing method and
Yes.
your variable costing
Variable.
method.
Okay.
Ne?
Yes.
Recover.
Yes.
Oh, siyabulela ke thina ngapha ke my friend ePitori.
Nizokubuza uba, are you speaking Zulu or are you speaking any other
Ngikhuluma
language because you
isiZulu
are
mina, my
mixing now?
friend.
Oh, okay. Okay.
Yeah, yabo. So ke are you following though?
Yes, I'm following.
Ne?
Yes.
Right. What did I do now? I wanted to color the tab. Okay. So now I'm going to learning unit 6. I'm done with learning unit 5.
Really?
Just like that, it's done. Yeah,
Wow.
well,
Okay.
learning unit 6, we are talking about overheads.
Okay.
Ne?
Yes.
Let me just double check if that is the case, but I think it is. Yes, overhead allocation. Overhead allocation, that's learning unit 6.
Okay.
Ne? Okay. So can you see the topic? It says overhead allocation.
Yes.
Ne?
Mm-mm.
Overhead allocation. That's very interesting, right?
Mm.
I-MAC ke chomam, it will want you to think. Yebo,
Okay.
ungafani nabantu basenkonzweni to shout amen before you understand.
Okay. Okay.
Uyayibona?
Yeah.
Because each and every word makes a difference.
Mm.
Uyayibona? So,
Okay.
overhead allocation, the question will be allocating it to what?
Yeah. To where?
Uyayibona? And
Yes.
this is allocated to a product. It is the same overheads that we spoke about it here. These overheads.
Mm.
Are you with me?
Yes.
Ne?
Okay.
So, overheads, ne? Overheads, right?
Mm.
Okay. Before we speak about the allocation, let's talk about overheads themselves, right? We have
Yes.
3 different overheads,
Okay.
right? We've got
Mm.
3 different overheads. Ne? We've got actual manufacturing overheads, right?
Mm.
E.g., your actual electricity bill,
Okay.
right? So let's do this. Let me give you an example. Anisha, we spoke about our process of producing igwinya, ne?
Yes.
Okay? So let's
Yes.
say our production process. Another thing that I want you to be comfortable with, ne?
Yes.
Production and manufacturing, we will use them interchangeable, right?
Mm.
So production slash manufacturing, we will use the terms interchangeable. Ne?
Okay.
All right. So what am I saying to you, Amanda? I'm saying to you, let's say our production process to produce amagwinya starts from January to December.
Yes.
Ne?
Okay.
All right. It is
Mm.
only in December that you can say the production process has been completed.
Okay.
Ne? But
Yes.
remember, from January, we are producing amagwinya. Ne?
Yes.
Right? We do not have a problem with material. Right?
Yes.
Because remember, as we put our flour, we are able to measure it. Okay, in 1 gwinya, we need only 2 tablespoons.
Mm.
Right? We don't have
Mm-hmm.
a problem with our direct labor, right? Because we
Mm.
know the hours that it takes to produce Ikunyeli 1 from
Anyone?
our
Yes.
employees,
Yes.
right? We don't
Yeah.
have a problem, right, with your sugar, your salt. Why? This is your variable
Manufacturing
manufacturing overheads,
overhead. Mm.
right?
Mm.
We don't have a problem with this because we know that, okay, if we produce 10 magwinyas, we use 2 kg of flour. And if we produce more, we'll have to buy more sugar. Are you with
Okay.
me?
Yes, I'm
Ne?
with you.
All
Mm.
right. But we've got a problem with your fixed manufacturing overheads. Right?
Okay. Yes.
We've got a problem with your fixed manufacturing overheads. Okay?
Mm.
Right? This could be your rent, right? This could
Mm.
be your telecom bill, and then loosely put, I can use electricity. Loosely put, my friend. Angisho.
Mm. Mm.
Okay? What are we talking about, Madam Amanda? Ne? We're saying this is a problem because if we're renting a property, my friend, ne?
Yes. Yes.
Or if we are using electricity, ESCOM only sends us a bill once a year. Ne?
Yes.
We
Yes.
will only get it at the end of the year, my friend. So while we're busy producing amagunya wetu, we do not know how much is electricity going to be at the end of the year, my friend.
Mm.
Are you with me?
Yes, I'm with you.
But now, as we are producing our product, it then means we have to value our product based on material, based on direct labor, based on variable manufacturing overhead. But we have a problem with if this manufacturing
So,
overhead because we do not have the bill from ESCOM yet, Mganwa.
okay.
Are you with me?
Yes.
Then to sort, because we cannot, for a product that we produced in Jan, my friend, we cannot wait to value it at the end of December, Mganwa.
Yes.
Are you with me? What
Yes.
then do we do? Ne? We
Mm. Mm.
then come up with what is called, ne?
Okay.
With what is called budgeted, budgeted, fixed manufacturing overheads.
Okay.
Are you with me?
Yes, I'm with you.
We will then estimate that, okay, our overheads could be so much
For a month.
for a month or for the
Okay.
whole year.
Okay.
Are you with me? In this case,
Ye-
it's going to be for the whole year because the electricity bill will only get it when at the end of the year.
Okay.
Are you with me?
Yes, I'm with you.
So after we've estimated our fixed manufacturing overheads, we'll also estimate the number of units that we can be able to produce in that particular year.
Okay.
Are you with me? Ne?
Yes.
So now it then means if you take your budgeted fixed manufacturing overheads, you divide it by your estimated number of units that you'll produce, you'll be able to get an allocation that you can use to value your product. Mngani.
Oh, okay. And
Can you
then
please
what
repeat that?
happened? Okay. And then what happens xa sekuphela unyaka and the electricity bill comes, ufumaniseka into
That's
yobana
where we
you've
are
budgeted.
going.
Okay. Okay.
Ne? So
Okay.
now it then means when we get to December,
Mm.
right? When we get
Yes.
to December, right? Those magwinyas that you have already produced in it, they've
Yes.
been valued in terms of material, they've been valued in terms of your direct labor, they've been valued in terms of your variable manufacturing overhead, and they've
Mm.
been valued in terms of your
Budgeted
allocated
fixed.
allocated fixed manufacturing overheads. Are you with me?
Okay.
Does it make sense?
Okay. I think I don't get the allocated fixed manufacturing
All
overhead.
right. So remember, I said we will come up with any a budgeted
The budgeted fixed.
fixed manufacturing overheads,
Yes.
right? We estimate the overheads that we'll spend, ne?
Yes.
And then we also estimate, right, the number of units that we will produce, ne?
Yes.
Right? So if you divide, right, your budgeted fixed manufacturing overheads by your number of units, right, you
Yes.
will get a rate, Amanda, that you will use. Let's say, as an example, ne?
Okay.
As an example, right, your material for iflower yako per unit, material per gwinya, ne?
Yes.
Which is your flour. Let's say it cost us 10 rand, ne?
Okay.
And then labor, we pay them 12 rand, right?
Okay.
And then your
Yes.
variable manufacturing overheads, maybe let's say they are 8 rand, ne?
Okay.
So now, and then I will divide my estimated fixed manufacturing overheads by my number of units. Let's say
Yes.
I estimate that, okay, for the whole year, ne,
Mm.
my fixed manufacturing overheads will be 50,000,
Okay.
ne? And then the
Yes.
number of units, right, that the
Yes.
number of makunyas that I'm expecting to produce, it's 10,000, ne?
Yes.
So to get the rate that I can use, I'll say 50,000 divided by
By
10,000.
10,000.
And then for my fixed manufacturing overheads, I get to money or 5.
5. Mm.
So now to get, and then my product cost, it's going to be 35.
Okay.
Ne? It's
Yes.
going to be 35. So now when we are saying allocated fixed manufacturing overheads, we are talking about this
Yes.
5 rand, because this 5 rand was allocated to the product, my friend.
Oh, okay. Okay.
Are you with me?
Okay. Yeah.
So that's why I said in this
Makes.
statement, there are 3 different overheads. Ne? You've got
Okay.
fixed manufacturing overheads, budgeted fixed manufacturing overheads, and allocated fixed manufacturing overheads.
Mhm. Okay.
Does it
Okay.
make sense?
Yes, it makes
Okay.
sense.
All right. Then now at the end of the year, Amanda, your actual bill comes,
Yeah.
right?
Yes.
Your actual bill, your actual electricity bill, it says 60,000, right?
Okay. Yeah.
And then let's say you produced 10,000. Your number of makunyas that you produced did not change,
Okay.
right? So
Yes.
now your fixed manufacturing cost per unit, it's going to be your 60,000 divided by 10,000.
10,000.
So now can you see your allocated, it's 5 rand. Your actual, it's how much? It's 6
It's
rand.
6 rands. Mm.
Are you with me? So
Yes.
what does it mean? It means when we're valuing our product, right, we under
Yeah.
allocated
Okay.
Amanda.
Yes, makes sense. Okay.
Are you with me? Hence here, we said in our
Mhm.
statement, right, for your absorption costing method, we said you can
Oh,
have your
oh,
over
and
or your under applied manufacturing overheads. It
mm.
is from this concept.
Okay. Okay.
So if it's under, you will minus. If it's over, you plus.
A plus.
Are you
Okay.
with me?
Yes.
Okay. Any problems there?
Uh-uh.
All
Clear.
right. It's clear, ne?
Yes.
Okay. So now let's talk about the methods of allocation. Ne?
Okay.
Methods of allocating overheads. Ne?
Mm.
Methods of allocating overheads, right?
Yes.
We have we have a traditional method, right? And activity based method. All right.
Okay.
And then let's first talk about your traditional method, right? Your traditional method, it is exactly what we did here, right?
Okay.
Your traditional method, it requires, right? It requires, okay, let me rather say, it calculates the, what is it called? It calculates the overhead allocation rate. And in our example, your overhead allocation rate, it's this one, the 5 rand.
My friend, yes.
Ne?
Yes.
So the formula is the formula is budgeted fixed manufacturing overheads divided by allocation basis. Ne? So
Okay.
in allocation basis, madam, ne? It could be anything, right? Your allocation basis, ne?
Mm.
Allocation basis is based on volume. Ne? So if
Okay.
volume could be hours, it could be
Okay.
labor hours, machine hours, right? It could be number of units, ne?
Mm.
What else? It could be production hours, right? And you
Okay.
can see it in our example, we used the number of units, ne?
Yes.
But your
Yes.
allocation basis can be anything, madam,
Okay.
ne?
Okay.
So now, for you to calculate your overhead allocation rate, you will have to divide your budgeted uh, overheads
Mm-hmm.
divided by your allocation basis. Ne?
Okay.
Are we together?
Yes, we're together.
Does it make sense?
Yeah, it does make sense.
All right. So budgeted overheads, you don't have to worry about it. It is always going to be given. And the allocation basis, it will always be given. When what you need to
Okay.
do is just the understanding and being able to calculate it.
Okay.
Ne?
Okay. Yes.
Okay.
That is the
And then
traditional method.
that's the traditional method.
Okay.
And then the second allocation method, ne,
Mm.
we usually call it ABC, which is the activity-based costing method, ne?
Okay.
Right? ABC says, ne, wait a minute, ne? You cannot allocate overhead based on volume, right?
Okay.
Because there are certain overheads whereby their consumption, right, of the allocation basis is different, my friend. Ne?
Okay. Say that again.
All right. So let's say you are producing igwinya nemuffin. Ne?
Yes. Yes.
Okay. how a muffin will consume electricity and how igunya will consume electricity will be
It's not the
different.
same. Yes.
You know what I'm saying? So
Yes.
then, just imagine we are then allocating electricity based on the number of hours that the oven was on, right?
Yes.
But now the way these products are consuming the overheads is different.
Yes.
Ne? So
Eh.
then EAPC comes and says, no, do not allocate based on volume because some of the products do not
Mm.
consume based on volume, my friend. Do not consume
Okay.
overhead based on volume.
Okay.
Are you with me?
Yeah.
Rather, allocate our overheads based on the activities that were involved when that product was being manufactured, my friend.
Mm.
Are
Okay.
you with me?
Yes.
Ne? So for you ABC, mngani wami ne, trust me, using a template for it and it will always be easy. Ne?
Okay.
So now, when we are calculating ABC, it's always easier with the table. Ne?
Okay.
What are we going to have? Ne? We're going to have, firstly, ne, we're going to have the activity, right?
Okay.
Okay. The activity in this case, all right, let's say we are producing two products. Our product is what? Our
Mm.
product is a muffin
And equine.
and equi, right?
Mm.
Okay. So now, our activities that might be involved, right? Our activities that might be involved that are related to these products, ne,
Mm.
could be, let's say, e-ordering. Let's say when we're ordering flour at ShopRite,
Okay.
ne?
Mm.
That's an activity. Ne?
Yes.
It could be also packaging when we're packing a flour in the storeroom. Can you see that?
Okay. Yes.
Ne? There could be a rent of a factory. Are
Yes.
you with me?
Yes.
Right? Let me think of another activity. It could be oven of which it's going to be a machine.
Yes.
Are you with me?
Yes.
These are activities that are involved, ne, when we are
Mm.
producing these muffins, right?
Mm.
But now we cannot trace these costs directly to these products, my friend. Therefore, we must find a way that these activities can be allocated to these products.
Okay.
Are you with me?
Yes.
Okay. So remember, when you are ordering, you will get your cost. Maybe you ordered for 10,000,
Mm.
right? You ordered for 10,000 here. Abantu abaphekaja, you charge, you pay them 15,000. Rent is your 5,000, and then just to service the oven, it's 2,000.
Okay.
Ne?
Yes.
Okay. So these will be your total overheads that you'll have to allocate
Mm.
to those two products. Are you with me?
Yes.
Okay. And then we say, all right, okay, we now need to do an analysis. Ne? And then in this analysis, my friend, right, we will
Mm.
need to see what drives e-ordering, what drives e-packaging, what increases your rent. Ne?
Okay.
So in analyzing what is driving these costs, we will be looking for any e-cost drive.
Okay.
Are you with me? Can you
Yes.
see where EABC comes from, my friend?
Yeah.
So it's engineering studies. Are you with me?
Mm.
So you
Okay.
go deep and you want to try and understand how these products consume these activities. Mngani wami.
Mm.
Are you with me? So for
Yes.
your ordering, my friend, right? It could be the number of purchase orders. Okay,
Okay. Yeah.
number of POs, right?
Okay.
Packaging could be number of orders, right?
Mm.
Iron square meters, right?
Okay.
Machine units produced. Are you with me?
Yes.
Okay. And then on top of that, my friend, we'll want to know, okay, the total number of purchase orders that were raised for both your muffin and the Quenya, let's say it was 100, right? And
Mm.
then for a packaging number of orders, let's say 200, right? And then rent total square meters, let's say it's, as an example, 500. And then number of units that were produced, let's say 250. Ne? So
Okay.
this is your total cost drive. Ne?
Okay.
And then here we'll have our allocation rate. Ne?
Mm.
Remember, when we were doing it traditionally, you just went straight and you calculated your allocation rate of 5 rand,
Yes.
right? But
Mm.
in this case, we'll have to break down all your overheads and understand what is included in those overheads.
Okay.
Are you with me?
Yes.
Right. So to get your allocation rate, it's going to be your total
Across.
activity cost divided by your total cost drive. Are you with me?
Yes.
Okay. I'm just going to use two examples there so that you understand. Ne?
Okay.
All right. So let's say we said, okay, so now, all right, maybe let me move. Ne? So now Anisha, we have 2,000. I mean 32,000. Ne? This
Mhm.
32,000 must be allocated to imafin nekwinya lakho mngani wami.
Okay.
Are you with me? So
Yes.
now, after you have done this analysis, ne, the
Mm.
next stage now will be to allocate, ne,
Mm.
will be to allocate the fixed manufacture, or let me say the overheads to the products,
Okay.
right?
Mm.
And then in this case, our product, it's a muffin and a
Mm-mm.
cream, right? How much do you have to allocate? It's 32,000, my friend. Angisho.
Yes.
So as an example, remember what we said, okay, what was driving this ordering cost? It was the number of purchase orders.
Mm.
Ne? So
Yes.
let's say for Igwinya, we had, uh, okay, for Imafin, we had 60 purchase orders, and then for Igwinya, we had 40,
Food. Okay.
right? And then
Yes.
in order for us to allocate that 10,000, we will say, right,
Mm.
60
60 divided by.
times 100, right? And then 40
Okay. Times.
times 100. And then what is our total? Our total, it's
Yes.
10,000,
And
which is the same as that one.
mm.
Can you see that?
Yes.
So now, remember we are saying, okay, we cannot allocate the 10,000 proportionately because the way the orders were done for Ama Muffins Namakwinya, it's different.
Mm.
Therefore, the 10,000, my friend, should be allocated, right, in the
Mm.
way this product consumed the ordering activities, my friend.
Mm. Okay.
Are you understanding?
Yes.
Okay. So this was ordering. Okay. We've
Yeah.
got packaging. We have rent. We have machine.
Mm.
All right. And then let's say here, for Imafin, we've got 150. And then here you've got 50. Lana, you've got 300 and 200. Lana, you've got 200 and you've got 50. Okay. So to
Yeah.
allocate packaging, it's going to be equals to 150 because there was 150 orders that were received from a muffin
Non-fit.
and there
Yeah.
was 50 orders that were received from a kwenyangisho. So it's going to be
Yes.
150 multiplied by your allocation rate, which is 75,
75.
right? And then 50
Yeah, by
multiplied
75.
by your allocation rate, which is that.
Mm.
And then we check if it's the same, which is 15,000 also.
Okay.
And remember, with the traditional method could have just allocated half.
Mm.
You understand?
Okay.
Which is
Yes.
7,500, 7,500. And then you can see, do you know why a lot of businesses get it wrong, ne? They get it
Mm.
wrong from costing. Because look, ne, if we're
Mm.
using a traditional method, we could have allocated 7,500, 7,500, ne? And then
Mm.
now you can see that Equinia will be overcharged.
Mm.
It will be
Okay.
overcosted, ne? So now
Mm.
it being overcosted, my friend, and then Imafin will be undercosted.
Understood.
Yayibona?
Okay.
So now you
Mm.
see, mara igwinya la kule company A, why is it so expensive?
Expensive.
Because if you go to kwezinye indawo nje abanama-management accountant abafana nabo
Mm.
Amanda nabo Mlamli kanje, igwinya lethu is
Mm.
valued at 3,750.
Mm.
Yayibona, my friend?
Okay.
Then this person is always surprised why people are not buying from him. Ne?
Mm.
What takes out businesses out of business? It is because they get the costing wrong. You can't
Wrong.
always start from your head, my friend.
Okay.
Do you
Makes
understand?
sense. Mm.
Okay. And you got your services to that spaza there at the shop, at the corner, Ahmed. Which you can help them with this, you will refuse.
Mm.
I wonder what my friend name. But you
Yes.
find the same guy for 15 years, he's still running the same path. He does not grow.
Mm.
Do you understand?
Yes.
Let's look at rent. Rent, it's going to be 300 square meters multiplied by allocation rate, which is 10 rent. And then 200 square meters multiplied by allocation rate, which is 10 rent. And then you get 5,000.
Okay.
Right? Machine, 200 hours multiplied by allocation rate of 8 rent. 50 hours multiplied by allocation rate of 8 rent. Right? And then we see how much is the total of our overhead. It's 32,000 exactly is that one. That's how the
Mm.
32,000 will be allocated to these products.
Mm.
Are
Okay.
you with me?
Makes
Whereas
sense.
if we're looking at the traditional method, name a
Mm.
traditional method, my friend, you know what it would have done, name?
Mm.
You have said, let's see. Okay, and you sure these are your total overheads.
Mm.
All right, which one can I use here? What's the relationship? Maybe I can just use the square meters. Yeah, Bob? So traditionally would have just said maybe 32,000. Ne? Let's look at it
Mm.
traditional as an example. A traditional would have said you've got 32,000, so it's gonna be 32,000, right? Divided by your square meters, 500. Then you get allocation rate of 64. Ne?
Okay.
Right? And then you'll say 64 times how many square meters for Iguinya? It's 300. I mean, yeah, for Imafin, it's 300. Why? Yeah, you're right. And then how many square meters for Iguinya? It's 200. And then just like that, it will be done.
Mm.
And you see, you still have 12,000. I want to show
Yeah.
you the mess
It,
of this method,
okay.
right? I want to show you the mess of this method, right?
Mm.
Check the difference. Ne?
Mm.
So, according to activity-based method, we're supposed to allocate 21,850. But
Okay.
this
Under
side we
allocated.
allocated in 19,200. So meaning we
Mm.
under allocated, my friend.
Mm.
Are you with me?
Yes.
So now, if we've under allocated, what does that mean? It means even the profit markup that will add on muffin, it will be incorrect, my friend.
Mm.
Are you with me?
Yes.
Because we got our costing wrong, how can we get our profit markup correctly?
It's gonna be incorrect.
You know what I'm saying?
Mm.
So now it means we are getting less profit on your muffin, ne? And we
Mm.
have over allocated on Iguinya, my friend.
Yes.
So now
Mm.
it then presents a problem there because other people in the market, maybe they can add just a 10% here as a markup,
Mm.
equals to this times 1 comma 10, and then they charge 11,165. Tina, this side we also add a 10%. Tina, we charge 14,008.
Mm.
You
Okay.
know what I'm saying?
Mm.
And I mean, we are living in a digital age where people are so much digitally involved. You know what I'm saying?
Mm.
So they
Yes.
will be able to know that store A sells equina 11,000. How
Mm.
come store B sells equina 14,000? And it's
10,000.
just a guinya. You know,
Yes. Thank
there's
you.
nothing special about it. It's just a
Eh,
guinya.
eh,
Yeah, you wonder where going.
mm.
So this is how it is. This is your learning unit 6. Mngano. I
Okay.
don't know if it makes sense to you.
It does make sense. It's interesting, actually.
Ne?
Yeah,
Okay. Any questions?
interesting. So far, no, everything is
So
clear.
far, so good.
Yeah.
All right. So this ABC is very topical.
Okay.
They will ask you separate questions on it,
Okay.
name, and then even these statements here, these income statements, very topical, you
Okay.
know. So it's something that we really need to know, ne?
Okay.
All right. I think I can stop here recording. Yeah, now. I wanted us to do those questions, but I don't think we'll do them again. It was just I wanted to use them as an introduction, but I'm not gonna use them again
Okay. Okay.
because it's I thought you had done E2601.